I started in the investment world at 11. I wish I'd started earlier, at 7 or 8. But I didn't get started until I was 11 for my first stock. Then I experimented with timing stocks, charting, and a bunch of other things. It was fun, but not profitable. I did that until I was 19. I devoured all the investment books at the public library. Every page was an adventure for me, but I had no framework. I was just searching, hoping that little patterns on a chart would reveal stock secrets. It sounds crazy now, but everyone else was doing it, so I jumped in too. Sometimes I'd flip the chart upside down, but it still wouldn't help. Then, in 1949, I discovered Ben Graham's The Intelligent Investor. I had never heard of him until then. There are really only 2 chapters in that book that matter. They laid the philosophical foundation for my investing journey. They're simple, yet incredibly important principles, like the 10 commandments, you know? The first is that a stock is part of a business. You can't see a stock as something separate. You need to value the underlying business. The important thing is to understand the economic characteristics, competitors, and management of the business. The second thing in the book is Graham's brilliant analogy about how investors should react to stock market fluctuations. There's no better explanation of how investors should approach stock prices. Most people react the wrong way to stock prices. Mr. Market is this mythical character who comes around every day, offering to buy or sell stocks at different prices. He's remarkably obliging, but also unreliable. Stocks are remarkable. Look at the highs and lows of American companies over the past year. You'll see cases where the high is twice the low. For sound American businesses, the stock price swings wildly. You don't have to play unless you want to. If you want to take the steps to financial freedom as quickly as possible, don't forget to like the video and subscribe to the channel. The third thing in Graham's book is the margin of safety. You wouldn't drive a truck onto a bridge with a capacity of 10,000 pounds if your truck weighed 9,800 pounds. You don't want to cut things too close when investing. With those 3 principles in mind, you can build all kinds of investment strategies. But that's the foundation. If you understand that, you're already ahead of the game. These principles have defined my investment philosophy and provided me with a compass to navigate towards success. For an investor like myself, the volatility of stock prices according to the market's mood may seem like a complex maze. However, Graham's teachings offer a solid roadmap, even within this labyrinth. Investors often react emotionally to market fluctuations. They feel happy when stock prices rise and sad when they fall. However, Graham is clear that these emotional responses will not affect long-term investment success. The metaphor of Mr. Market is a powerful tool to steer investors away from market noise and encourage rational decision-making. When evaluating a company, I first look at whether the business has a durable competitive advantage. The deeper the moat surrounding the business, the further it is from competition. Additionally, having an honest and talented management team is critical to me. Finally, the price must be reasonable. No matter how good a company is, an overpriced stock is not attractive. Therefore, as an investor, one must be sensitive to market fluctuations. Make decisions based on fundamental values and be patient. As I always say, patience is the key to success. When it comes to sharing my experiences in investing, I focus on evaluating a company's business model first and foremost. A stock should be assessed based on more than just its market price. I consider the underlying business. For instance, I look at a company's market advantage and long-term performance in the market. Regarding market fluctuations, I often use a metaphor called Mr. Market. This allows investors to evaluate market movements without succumbing to emotional reactions. Instead of reacting to price fluctuations, we must focus on the fundamental values of the company. Furthermore, it's crucial to determine a company's true value and purchase it at a reasonable price. Regardless of a company's strength, an overpriced stock will not yield returns in the long run. Therefore, we must make investment decisions based on sound and fundamental analysis. In conclusion, when investing, you must not succumb to emotional reactions and think long-term. This is the foundation of a successful and sustainable investment strategy. If you want to take the steps to financial freedom as quickly as possible, don't forget to like the video and subscribe to the channel.